Well, we have, five people and 3 microphones. So let the fighting begin!
There's a fireman at the door saying we can't have any more people in. So don't even try to show up.
All right, wait. It's the Montana World Affairs Council on the radio. Our good buddy, Bob Seidenschwartz. Bob, I'm relegating the microphone to you.
Guten Morgen, Peter.
Hey, what's happening, man?
Hey, we got a full house, and yes, it is. Yes.
Wow.
So I've got my 2 colleagues here from SG Long today, Josh Jenny, who's been a guest on the show before, and Tom Kerr. Tom recently joined us. We say goodbye to Otter. Otter, his wife took a job in Pittsburgh, PA. So they moved the family, and we miss him and wish him well.
But he can't commute from Pittsburgh?
Not even with telecommuting can he do that. So, no, but we wish him the best. But we've got Tom, that is a certified financial analyst that has joined the firm. And we've got both these gentlemen in studio today. So we thought it was probably about time to do a little bit of an economic kind of checkup, where we are with the economy. I get clients and friends asking, about the oil issue all the time in terms of prices. Are they going lower? What's the effect on this? So we'll start out today talking a little bit about what the effect has been in terms of this pretty dramatic drop on oil prices. And we'll just kind of let the conversation go from there. So, gentlemen, I want to welcome you and our newest member, Tom.
Good morning.
Welcome to Montana. Tom is originally from California. So let's give him a big, warm welcome. All right, that's enough. Okay, he's from California, so we don't want to make him feel too welcome.
Says the guy from New York.
Yeah, exactly.
Hey, but you don't be messing with me.
We're already doing a standing ovation because we're all standing. All right.
Josh is apparently a 6th-generation Montana, halfway to the Senate. So I haven't heard a single joke made about him.
Right.
Anyway, all right. Well, Tom, first of all, tell us a little bit about yourself and your experience and how you got in touch with these guys at SG.
Sure. First of all, Bob, it's a chartered financial analyst, not certified financial analyst. I have to correct that, or I would actually lose my charter. I would lose my charter if I didn't correct that. But I've been an institutional investment manager for quite a number of years in Southern California since the early 90s, and my firm got bought out in 2011, and I started my own firm. I actually started a mutual fund in Southern California. I say in hindsight, unfortunately. Very expensive to run, but I shut that down, and this job opportunity came up at SG Long, and they hired me, and here I am.
All right. Well, welcome. Now, did you have family?
My family's still in Southern California. They're going to move at the end of the school year, so the house hadn't sold, and we've got 3 kids, 3 dogs, and they're looking forward to moving up here, but they couldn't make it up here in the initial move in October.
Well, you have a lot more room here than you will in Southern California.
Yes, quite a bit. Not much traffic either. So.
Well, we welcome you.
Thank you.
So are you excited? You like Montana so far? Is it?
Oh, so far I like it.
Except for Bob.
I love it. I love the outdoor. Yeah, exactly. Except for the people at the firm, it's been wonderful.
Okay.
No, it's,
and thanks so much for being here. Too bad you couldn't stay with us.
No, it's
We'll be waiting when you get
No, wonderful people, wonderful town. We're outdoor people too, and we kind of wanted to raise our kids in a small town mountain environment. So I just love it so far. And
You've already sustained your first soccer injury.
Yes, we got my first injury, and more to come from all the skiing and biking, of course.
Well,
but
there you go.
No, I love it. And people told me that you probably love it because your kids and wife aren't here. But I think I don't think that's the story. So.
You don't want to get in trouble both at work and at home.
Yeah.
We should probably just stop the jokes there.
And this is not broadcast in California, is it? Or it's not webcast or anything?
We found out about the internet about 2 years ago here in Montana, and we've been using it ever since.
As a matter of fact, we do stream.
Uh-oh.
So there you go.
I should have told
Now let's talk a little bit about, if you don't get serious for a second, about oil prices, because those of us who are not necessarily really, well educated about financial issues do notice oil prices because it caused an amazing dive in gas prices, which made everybody happy, with probably a few exceptions, except those who had investments in oil companies.
Right.
So tell me where that's going, because we had been expecting it. Oh, the powers that be will jump in again, and they'll inflate the price again, and we'll have to pay $4 for a gallon for gas again. So can you tell us about that? And is that going to happen?
Sure. I mean, it's hard to predict in the short term or the medium term where oil prices or gasoline prices are going to go. And as in most things, there's gives and takes, pros and cons, positive and negatives. And maybe just look at the few positives. Obviously, it's good for the consumer when gas prices go down this much. I think estimates are anywhere from $600 to $700 a year in savings for the average consumer in America.
That's a lot.
That is a lot. Now, what they do with that is the question mark. A lot of them are saving it. A lot of them are paying off credit cards. And that does not have an immediate boost to the economy, because there's not a lot of consumer spending or increased consumer spending. But we do see the positives from the savings, from the paying off credit card debt, the deleveraging of the consumer. And it's also positive in that there are a lot of industries that are very fuel intensive, transportation, airlines, utilities, and those companies are seeing a big benefit. And that is, of course, helping those companies' profits, their employees, their wages, and that sort of thing. Now, on the negative, this oil boom we've had with the shale industry in the last 3 to 5 years has been an enormous boost in employment. I think it employs somewhere between 300 to 400,000 people in America, and most of those are high-paid jobs, especially up in North Dakota, in the shale area that way. So those jobs are going to be diminished to some degree as drilling and exploration slows down. So that could have a negative effect. So those are the first immediate thoughts in terms of the positives and negatives.
So, Josh, bring you into the conversation a little bit here. Let's go back to what was kind of the catalyst for this drop in prices. And that goes back, of course, to a meeting that OPEC had several months ago, which was quite unexpected. So from that point, kind of take us forward as to some of the, I guess, rationalization on their part. What do you think they were attempting to do when they announced that they were not going to cut production, which historically has been the case when they want to keep a ceiling, or excuse me, a floor under oil prices?
Mm-hmm. As a lot of people know, OPEC has, or some countries, some areas within OPEC have access to very, shall we say, sort of cheap to drill oil. They're able to get it out of the ground at a much lower cost than we are, and in essentially all areas of the continental U.S. and certainly offshore. Offshore typically is a more expensive extraction method. So what they're able to do is take a lower profit on oil that they produce, but still earn a profit while American producers at that same price are no longer profitable. Right. So it becomes sort of a war of attrition that they've engaged in or chosen to engage in. It's been a sort of relatively short period of time thus far. I hear myself saying a lot that the real question we all need to ask from both an investment standpoint and perhaps just from an economic standpoint is not how low will oil go. People love to throw around $20 a barrel because it's a flashy number. But the real question is how long can oil prices stay this low? And what does that mean for the global political environment? What does that mean for the domestic consuming environment? What does that mean for as Tom pointed out, the domestic employment environment? If it does drag on for years as opposed to months, then that could be pretty meaningful in a lot of different ways.
So let's talk about this for a minute then in terms of why did they engage in this attrition? What were they attempting to do? Because they had a very specific reason, at least we're being led to believe that they did. And of course, the implication, well, yeah, because I want to ask too, in terms of the implications to these oil producing countries, which need much higher prices in order to sustain their economy. So what was the original intent, do you believe?
Although I believe it's unofficial in the sense that OPEC hasn't sort of formally attributed their action to this sort of economic strategy, it's widely assumed that the intent was to push out more highly leveraged U.S. producers and really shale producers in other areas of the world as well. We just feel it more acutely here because it's such, as Tom pointed out, from an employment standpoint, it's such a recent positive development.
I wanted to ask whether or not the market over here is more flexible. I see your hands. Peter's dancing behind the screen. That's beautiful, Peter. I love the pirouette. When we get back from this break, which I now signaled that we need to go to, I wanted to get your take on whether or not you think that the oil market here in the U.S. is flexible enough to bounce back if prices get jacked back up in the future. Because a lot of people are thinking maybe they'll lower prices for a while, push other people out of this business, and then when the people are out of it, they can pop back into the market without much competition.
Okay, so we'll come back and talk about that. By the way, we have all three lines open. If you have a question for these gentlemen, these are folks who they work with money and economies and world currencies every day. So if you have a question, give us a call, 721-1290. Love to answer your questions. We'll be right back. We're back on Talkback, and it's Wednesday. It's the Montana World Affairs Council on the radio. Our good buddy Bob Seidenschwartz with us. He has brought his friends from SG Long and Company, Josh Denny and Tom Kerr. And
let it be know that he pays all of his friends.
Well, there you go. So now you just asked an important question, John. Now about strategies involved in oil prices.
Yeah, I think that this OPEC thing is basically them trying to test the market to see how flexible it is in the future. I think it was kind of a test run. And anyway, I'm wondering if our market is flexible enough to go offline and come back online, that sort of thing, if needed, and whether or not this is what I thought it might be, to see if they could push a whole bunch of competition out of the way and then jack prices up to recoup their losses in the future.
I would say the answer to that is it is a very flexible industry simply because they have been through this before many times. Ironically, I grew up in the oil industry too, and certain years we'd go through bad cycles. My dad would say you can't buy tennis shoes this year, where the prior year we did pretty well. So that's a very flexible industry in that they can cut staff, they can be efficient in how they operate rigs, they can, reduce rig counts pretty quickly. So it can come back pretty quickly, and they know what they're doing usually because these veterans of the industry have been doing it so much. So I would say once oil and gas prices do rebound, except for the marginally levered players that can't operate successfully in this type of environment, I think most quality companies can come back.
To give an example, there's 3,000 wells right now that have been drilled and have just been put on hold. So if you want to talk about production that can quickly be ramped up again, this is what can happen out there. And people have to understand that fracking is not like drilling conventional oil wells. These things now, because of technological innovation and the ability to use the methodology, they can put a well in place in about 30 to 45 days. So it depends, of course, on a number of variables, but that's a radical change from what existed 10, 15 years ago. So in answer to your question, things can ramp up pretty darn quick.
Okay, go ahead. Did you want to say something, Judge?
Yeah, the one thing I would add is where they're not flexible is they can't take a barrel of oil that's in the ground that would cost $60 to extract and turn that into a $20 barrel extraction cost. So a lot of that component of it is pretty fixed. So if this dynamic plays out for however many years, for those amount of years, that barrel of oil doesn't get any more profitable over time. It stays in the ground as, a barrel of oil that you have no economic interest in getting to.
Okay, let's get to the phone and say good morning to Chuck. Chuck, you're on with Josh and Tom and Bob.
I just want to say I have two questions. Number one, under Hillary Clinton as Secretary of State, the Assistant Secretary of State said we've agreed to keep oil prices up around $100 a barrel back for a certain period of time to help women's rights in Saudi Arabia and other countries over there. I would like to know if this person knows anything about what I'm talking about. Number two, I'm on my way to Spokane. I'm going to open up a credit union account. I'm going to put $20 in. They will then in turn send me a debit card with a limit of $1,000 that I can use immediately.
Okay.
Are you aware of that one?
No, I haven't heard of that. Oh, well, have a safe trip, Chuck. First question. This Assistant Secretary of Secretary of State with the whole business with $100 a barrel oil. Is this something you guys have heard about?
I'd say, how's that working so far? I have not heard about any kind of quid pro quo. I think that the market is too massive, too powerful to allow anybody to have an agreement of that type to manipulate in terms of women's rights and keeping oil at $100 a barrel. And as I said, how's that working?
Right.
All right. And what about the whole debit card situation? You pay $20 and you have an immediate $1,000 limit. I mean,
it's a line. Watch out for the interest. That's all I'll say.
Yeah. Anyway. All right. So 721-1290 is our number. 1-800-568-5309.
Okay.
Go ahead, Joe.
I've been listening to a bunch of different market stuff. This is my day to do that since you guys are coming. And I've heard a lot of people that are pretty freaked out, like from a whole bunch of different parts of the market talking about future bear markets, declines 30 to 60% in the stock market. Is this just the weirdos that get on the fringy sort of communiques, or is this something that's pretty common? People expect the market to shoot down.
I would say, nobody can predict the markets is the first answer, especially in the short to midterm. There's a lot of speculation that we're going to enter a bear market, have a crash, but nobody knows for sure. If anybody tells you that, they probably don't know what they're talking about. But I will say, in regards to that, the valuations in the stock market are pretty darn high. We've had a 6-year bull market, which is pretty exceptional. It's the second or third longest bull market in American history since the depths of March 2009. And so these great companies that we all know about are all trading at very high valuation multiples. And what it means is that returns going forward from here are probably not as strong as they will be going or have been in the past, at least the past 5 or 6 years. So it is a little disturbing, and there are risky signs out there. The economy's not growing like it should. There's Middle Eastern tension. Europe's not growing as well. Oil prices might have negative effects on geopolitical instability around the world. So to answer your question, nobody knows if an imminent crash is coming, but there are elevated risks, which I believe at this time.
Okay, we're going to take a quick break. Come right back, 721-1290. And I have a question I want to throw at you guys. With the rise of ISIS, let's say that a coalition does not emerge to stop them, and they end up taking over a good part of the Middle East and start getting involved in the oil markets and start playing havoc, if you will, with the economy of the world. I want to throw it at you guys. What's going to happen? Will America then ramp up production and try to say, we don't need you guys anymore? Or I'm just throwing it out in the future and asking you what you think, because this is what you guys do. You think all day long. 721-1290 is our number. We're coming right back. We have all 3 lines open, by the way. We'd love to hear from you. Let's talk back. 721-1290 is our number. 1-800-568-5309. Sorry, I can't help myself sometimes. All right, let's get to the phones and say good morning to our friend Catherine. Catherine, you're on with Josh and Tom and Bob. Hi.
Oh, good morning, guys. Estimates have been postulated that 50% of lower-tier jobs will disappear in the next 10 to 20 years due to robotics and automation. How is this, or will this, revolution in 3D technology and robotics start, or is it already impacting oil drilling and the labor market in the energy field over the next 20 years?
Okay. Thanks, Catherine. So, gentlemen, hold forth.
Well, the 3D market is interesting, but at this point, it's way too small to make a dramatic impact. Over the next 10 to 20 years, it's possible to have an effect on labor, employment, automation, and that sort of thing. But at this moment, at least in the near to midterm, it won't have a dramatic effect.
Well, can I throw this in here? What about the potential in the rise in minimum wage, where so many companies are hiring people, at entry-level jobs? Well, if those entry-level jobs go up to $15, $16 an hour, then it just pays them to figure out how to automate and get rid of those jobs. So could that actually accelerate?
Could you have a race discussion with an automated robot at Starbucks? Probably not.
I don't know.
They're planning for the future here.
So what do you think, Josh? Oh, go ahead.
Yeah, it's been interesting to watch the sort of changing landscape of American employment. It has and sort of continues to be shifting more towards a service-based employment model. The Starbucks joke is a good one, but a robot will never serve you your coffee at Starbucks. It'll never help you in sort of the role that a nurse might giving birth to a baby. There's certain skill sets that require that human component and arguably always will. And certain ones that could be replaced.
So a question for my colleagues. First of all, Catherine, in terms of the technology innovation in the energy industry, it's been nothing short of kind of amazing to see what's happened in terms of identification, extraction, and reduction of cost, hence why we're having this revolution in the oil and shale gas industry. So these will continue to be drivers in various types of industries. But I'd like to ask both Tom and Josh in terms of where you see, just if you're talking to a young adult, in terms of where you would look to the future for job opportunities and skill sets, where would you go and why?
I would say learn how to write code, learn how to deal with servers.
Greg Gianforte right there.
Yeah. It's that's not going anywhere. That will require a human skill set. The ingenuity it requires to build software from the ground up is frankly not very entertaining subject of study for most 18, 19-year-olds. And so from an employment standpoint, from sort of a supply and demand standpoint, it's severely undersupplied. And I think that, in the mid to long term, that will probably stay the case.
So rather than getting them from some from China or India, why not get them from the University of Montana, right?
Yeah, sure. I mean, it's domestic programmers are very strong. It's just that there's not enough of them.
Yep. Well, go ahead, Tom. Real quick.
I would agree with that real quick. I would also add engineering to that skill set, whether it's chemical engineering, mechanical engineering, automation engineering. There will be huge demand for that going forward in conjunction with computer sciences.
Okay, we're going to come right back. We have to take our hard break here. We have a top of the hour, and we have two other lines open, 721-1290, and we're coming right back after the top of the hour. Okay, it's the Montana World Affairs Council on the radio. Hour number 2 is underway. We've got Bob Seidenschwartz in studio along with his compatriots from SG Long and Company talking all things financial. Josh Denny and Tom Kerr both with us this morning. And we promised we'd get right to Wes after the break. So, Wes, first of all, thank you for your patience. You're on. Go ahead.
Yeah, good morning. From having worked on the rigs, what I tell my son is learn your computer skills, develop your math skills, and because there's always going to be a need for guys to maintain these rigs and run the systems. I'm just a lowly motorman, but our diesel electrics run 3 big cat diesel engines, and we have we're an AC rig, so we have a power unit that runs the whole rig, and so there's electricians, welders, all those skills that people kind of look down on, the blue collar skills, but are still very technical. They all translate, and we have guys that, when you talk about mathematics, the directional drillers, there's the guys that monitor well drilling, the MWD hands, and these are the things that have led to the shale revolution with the directional drilling. And there's just so many facets to the industry on the drilling side of it. Now on the production side, downstream, I'm sure is very different. But from my experience, they can automate. One of the callers asked about automation. Well, they do automate, but you still need someone to maintain that equipment and know how to run that equipment.
So, Wes, we were having this conversation actually off air, exactly to the points you're making in terms of within certain industries, there's still a need for those kind of traditional blue-collar skills. So here's a question for you. With a downturn right now, guys are getting laid off. Assuming that prices will come back and such, will a lot of these gentlemen come back into the business, or as a result of being laid off, do you see attrition where they've got to go find other work and in some cases don't come back in when times get good again?
Well, that's a concern that is prevalent. Right now I'm off almost for 2 months, but I have a job to go back to. We're waiting on some dirt work. But there's a lot of guys that, they're leaving the industry, and this is probably, in a way, it's a good thing because you had, with such a great expansion, you've got a lot of guys that don't belong there that have been out there working that should be doing something else. But yeah, that is a concern, and I read an article that addressed just that, where they're concerned that guys will leave and then they'll miss a whole generation, and that's what they're actually experiencing because you have guys. I'm pushing 50, and they're having guys in their mid 40s to 50 that really aren't there to take over the management jobs. So you have a lot of really young guys that are moving into management, and they're afraid they're going to have that happen again.
So, Wes, from a technical standpoint, you have to have the training, but also just from an experience standpoint, drilling in the industry is art and science. So when you're talking about losing some of these older, more experienced workers, what kind of effect in terms of mentoring and experience to actual operations does this have as an effect on the industry?
Well, okay, my experience is limited to the drilling aspect of it. Right now I got a demotion, so I'm back at a lowly floor hand just with all the job cuts. Everybody took a cut. We've had cuts in pay as well. But from the standpoint is, with lower experience, your utility rate, your effectiveness is going to be lower because you don't have guys that understand how to keep diesel electric rigs running, or they don't understand the maintenance of mud pump systems, or how to run the tanks, and basic floor work. So in some ways, it's good to get a guy that doesn't have much experience. You can train him. He doesn't come with a lot of bad habits. But on the other hand, they require much more supervision.
Right. I'll just add that I think Wes's point, your first point was very interesting about the technology aspect. And these service companies, these oil and gas service companies, Halliburton, Baker Hughes, Schlumberger, they're spending billions and billions of dollars in R&D every year. And that is to make it more efficient. And that does involve the technology, the computer science aspect of it. So you're right. I think that's where the opportunity is going to be in the service industry going forward.
That's where I think the high-paying jobs are. If you have a technical skill, you will be compensated for it.
Yep.
All right. Hey, thanks, guys. It's a great discussion.
Thanks for the call, Wes. Always a pleasure to hear from you. Glad you're back home safe. Take care.
Bye-bye.
Take care. All right, there you go. So go ahead, John.
I wanted to ask: Do fiscal analysts look at all to the supply of students? Like what kind of programs students are going into when they go to the universities to help judge whether or not certain markets are going to be cheaper in the future or have easier access to employees in the States, that sort of thing?
You asked, do analysts do that, or
do you check like what kind of classes students are enrolling in? What sort of things? I mean,
Sure.
because apparently there's going to be a huge burst in the English language. We're going to have a lot of money soon coming out of English.
Yeah, I think that's what you're getting at in terms of when you're analyzing companies or industries. You know, what is the labor supply? How's that going to affect the cost? Certainly, we do that. We know there's an engineering shortage in America right now, believe it or not, where that could affect companies' costs. Where you're a mechanical engineering company, a consulting company, a drilling company, there's not enough engineers being produced in this country to fill those needs right now. So we look at these large-scale technology companies, even if it's electrical engineering, and they can't find people. Those have to come from overseas right now. So, yeah, I think to answer your question, yeah, we certainly look at that, seeing where college trends are going, see what people are going into, and it can't all be liberal arts majors. We need engineers and computer scientists.
Well, now don't tell that to the University of Montana. All right, we need Russian language and art history, and all that's important.
Yes, we do.
Okay, we're going to come right back. 721-1290. Oh, stop! Don't throw things at me. I just got fired. We're coming right back with more of Talkback in a moment. Hey, we're back on Talkback. 721-1290 is the number. The one question that I asked before the top of the hour break, because I wanted to get our caller in first, is the impact of ISIS. ISIS is it's spreading. It's becoming more and more powerful, taking over more cities. It has been involved somewhat in the oil market. What happens? God forbid, Iran gets a nuke and kaboom goes the Middle East. What's going to happen to the oil markets? Because you had just mentioned what people don't realize when we think about importing our oil from the Middle East. Give us those percentages that are in existence right now as to where we're getting our oil from.
Sure. Roughly speaking, over the last 2 decades, we import about half of our energy needs in terms of oil, but about 10 or 12% of that comes from the Middle East, believe it or not.
10 or 12%.
Right. Okay. And the other 40% comes from Canada and Mexico.
All right. So let's say there was a horrible disaster in the Middle East, whether it was a natural or man-made disaster, whatever, and the flow of oil had to stop for a while or for some significant, pinch off there. So what's going to happen to oil prices around the country? Go ahead.
I would sort of point out that there are areas of the world, such as Europe, et cetera, that would be much more adversely affected by that sort of cataclysmic event than we would initially. But the effects that Europe would feel from, just because they get so much more of their oil from that region of the world, the effects that they would feel economically, I mean, it's a global economic environment. They'd certainly make their way to our shores very quickly.
Yeah, and the Middle East has roughly about 70% of the known reserves right now. Now, that could change going forward. So to Josh's point, it makes a big impact economically in terms of global trade, pricing, currencies, and things such as that. And give you a little example, Libya, which had been under Gaddafi, a fairly significant oil producer, when he was deposed and the revolution had taken place, Libyan oil production dropped pretty precipitously. It then came back online, but to Catherine's point about ISIS, there's quite a bit of activity within Libya right now, which has, again, there's kidnappings, there's refineries, and there's oil production areas that have now gone offline or at least have reduced pretty substantially their oil production. So while Libya added to this equation of too much oil on the market, a good portion of that has come off the market. So you do see the effect of this type of activity in certain countries and regions having a direct impact on production.
Just supply and demand.
Yep.
Speaking of Europe, since it was brought up, one of the things that people think might float the U.S. economy for a while is the fact that everyone else is so screwed up that we're the best thing to invest in. I wanted to get your take on that. We had talked about bear markets earlier and mentioned a bunch of people that had kind of thought that things were going bear. And I put in a clip in our system here. This is a guy that runs an investment group. It's called Prudent Bear Financial, or Prudent Bear Investments. I can't remember. I think his last name is Tice, and
Yes.
he was on, I think it was CNBC not too long ago, basically talking about why he's so confident that the market's going to go down.
Okay, here we go.
Frankly, we don't think quantitative easing is the key to long-term success. This is a short-term fix. Longer term, it's not going to work. This reminds me a lot of what happened in 1999 and 06 and 07 when I was warning people about it. People were complacent. The VIX was very low. Complacency was high. However, we had massive declines. The Fed has been able to engineer a nice recovery in asset prices from 09 to 14. However, trees don't grow to the sky. And really, if you look underneath the economy, you can see that our unemployment rate is benefiting from a decline in the labor participation rate, a move to part-time employees. Even people like Janet Yellen are talking about certain asset prices are stretched. BIS is talking about the market's euphoric, and even Stanley Fischer has talked about a longer-term structural slowdown in the economy.
You know, David, what about those who say that, yes, all of those things may be in place, but because markets in other parts of the world are struggling, we saw German bonds actually go negative in terms of yield this morning, that the U.S. really is the only place to put capital to work, and therefore, despite some of the things that you laid out, that will continue to underpin asset prices.
This is certainly an unprecedented period of history where we have central banks around the world having this amount of monetary ease. And we see Japan, the UK, Europe now, the U.S., China's slowing down. All these things. This is certainly unprecedented. However, I don't believe it ends well. This has happened over thousands of years of monetary history where governments typically want to make promises and give out, bennies to their constituents, and they do it by debasing the currency.
All right, so there you go.
All right, were you enticed by Tice's argument, or do you disagree? What do you think?
I'm going to let Josh, this is Tom, I'm going to let him expand on this. He's our Federal Reserve expert and fixed income expert, but I do believe one point he said is accurate, and this is somewhat of an artificial market created by these central banks. They have pumped so much liquidity into the market that perhaps, and it's a speculation, of course, rates aren't what they should be in a normal market environment. Stock prices aren't what they should be in a normal environment. So in some sense, they have distorted the market, but who knows what a normal market should be. So do you want to expand on that, Josh?
And Josh, as our representative from the Federal Reserve Board, as you're about to speak,
No.
please explain. You like that, huh?
And try to do it without yelling.
Yelling.
Oh.
Could you also, please, for the benefit of the audience, when they hear negative interest rates, I don't think people kind of comprehend what does that actually mean and what the implications are.
So last time I looked, and it's been a little while formally, but I know at least the German 5-year was negative for a period of time. What that basically means is that if you buy a German Bund, as they call it, you're locking in a negative return over a 5-year period of time, which sounds crazy, and arguably is. You're making that trade because the ECB is also buying those same bunds at negative yields also.
Hey, gentlemen, we're up against a break, and I have a question for you. What would, and I'm going to ask all three of you gentlemen, if the markets were allowed to simply be themselves without all the interference from the central banks and from the Federal Reserve, and they were allowed to basically just float on their own and decide things themselves, where would interest rates be right now in a really balanced market, and so those other things that go along with that. So we'll come right back. We also have all three lines open, 721-1290 or 1-800-568-5309. All it takes to get the conversation going during the break is ask what if to a bunch of financial guys. So 721-1290 is our number, 1-800-568-5309. I asked the question, where should, if the Federal Reserve didn't get involved in quantitative easing and all the other banks, reserve banks around the world didn't get involved to try to influence and lower and raise and if you will, help and assist or whatever, where would or should markets be right now? So who's going to jump in on that? Josh, Tom, Bob? Go ahead.
Sure. I think the first thing to do that's really important is sort of bifurcate between short-term rates and long-term rates. And by long-term, I mean 5 years and out would be considered, mid to long-term. Short-term rates are really typically in sort of let's all hope, a post-QE world, the only rate environment that the Fed really interacts with under normal circumstances. They deviated widely from that with the QE programs post-09. Short-term rates without the Fed would be determined by nothing other than the banking system in the United States. That's really the primary thing that they functionally affect, they being the Fed. So if banks had to be sort of more competitive for deposits, you'd create sort of a different environment where perhaps minus that regulatory influence, you'd have banks kind of racing to pay you more on your deposit rates and perhaps overextending themselves because that's an expense. Very difficult to kind of put a number on that, on the short-term rates minus the Fed. Mid to long-term rates, it's a little bit different. Those rates should, under normal circumstances, just kind of in economic theory, if you will, should sort of reflect some sort of additive combination of expected inflation and expected growth over that period of time. So if you say over the next 10 years, I expect 1.5% inflation and 2% growth, then you should expect at least 3.5% from that 10-year bond. So the real question becomes, or the way to answer your question becomes, what do you see out the next 5, 10 years, 15 years? Do you see this sort of stagnating economy like Japan has experienced for the last 2 decades with intuitively very low yields resultant from that, very slow to no growth, very slow to no inflation. In that sort of environment, then, a 10-year bond at, 2% or whatever might be a reasonable number. But if you expect growth to pick up, expect inflation to pick up, then you will see long-term yields move dramatically if that does happen, A. And B, you should certainly expect to get more from that 10-year bond than you get now.
So basically, you're saying that pessimism drives a lower bond yield. Is that basically a good surmise there? Okay, I'm freaking out because as Tom pointed out, we have a bond history, bond ratings for Europe going back. Like I have a charts here for France that go back to 1746, 1788 for Spain, Italy 1807, Germany 1807 as well, Netherlands, Portugal, all these states going back. Oh, Netherlands goes back to 1517 for crying out loud. So we have a long history of bonds in Europe, and I'm not kidding. I'm looking at every single one of these countries. At no point in time, with the exception of Germany, who's, let's be honest, made a few miscalculations, we're at the lowest for all of these countries ever.
Okay, so
is that frightening?
Who wants to jump in on that? So go
I would say we're probably closer to the bottom than the top in terms of rates. That's for sure.
So what I want Josh and Tom to kind of vet, though, is having this conversation about low interest rates. Let's assume that they have nowhere to go in time but up. So if you're a bondholder out there, and I want them to describe the type of maturities and possible type of bonds that would be negatively affected if interest rates move up. I've been in the business long enough to remember a few cycles when interest rates were going up, certain types of bonds got pummeled. So let's have a little discussion about this.
Yeah, from an investment management standpoint, and we really do this just sort of as a methodology. It's not necessarily a call on how low rates are or aren't right now, but we try to stay as short as we possibly can in terms of maturity or duration. They're kind of
So why do you stay short, though?
Okay, so
and please describe what you mean by short and long for those dummies out there like me that don't know what
really
that means.
Excited. People are going short.
Remember, guys, this is 101. So
just because I'm the shortest guy in the room, okay? Come on.
That's a fair point. Sorry. Own a bond with a 5-year maturity in preference to a bond with a 30-year maturity.
Yeah. And rates move a point up. What happens?
Rates move a point up, and I'm highly simplifying it, but in terms of the math that sort of goes behind it. But the 5-year bond, the rates go up 1 percentage point on that 5-year bond. That 5-year bond goes down somewhere around 5%. And in terms of capital value or volatility, you still get your same money back at the end of that 5 years as you do with the 30, but you experience much more price volatility. That 30-year bond, you're talking about a 30% capital move.
Right. So when people think about equities being more volatile historically, or at least from a perception standpoint, we need to be able to say, look, with the wrong type of maturities, interest rate movements, bonds can be, to your point, extremely volatile and detrimental.
Right. And that's why we try to stay as short as we can, because we want the bond component of portfolios to provide stability, not be kind of a momentum trade.
Now, the bad news on that is on the equity side, which higher interest rates or rising interest rates is not good for equities either, for two reasons. One simple and one a little more complex is, one, there is alternatives. So if you can get 2% in a CD, maybe you don't want to take the risk in the stock market to get that 2% dividend yield. And then secondly, higher rates discount cash flows, which how you value a business discounts them at a lower amount or a lower valuation. So rising interest rates are not that positive for equity markets either.
So is that the reason why all this quantitative easing? First of all, I realized there was a crisis and they had to jump in. Okay, and the whole idea is to stop inflation from happening in an artificial way. Was that the main reason, or was it just simply to stabilize the markets?
At the end of the day, the Federal Reserve really only interacts in interest rate markets.
Okay,
and that's. And certainly, yes, it was their obviously that in a very explicit way they brought short-term rates very low, and the reason that they engaged in the QE programs was to influence longer-term rates, which again they don't typically do. You can make an argument whether or not that was a good idea, but what I don't think you can make the argument of is that they didn't affect mortgage rates. Mortgage rates typically correlate to the 10-year Treasury over long-term time frames. That action was likely helpful in healing the housing market, which needed significant healing post 08-09. Benefited a lot of individuals who were able to sell their house. Brought a lot of homeowners just from the demand side. Brought a lot of homeowners out of underwater mortgages. Not all. There's certainly areas where that's still a problem. But so yes, our Federal Reserve and frankly global Federal Reserves have been trying to influence our interest rates. So when you see negative German Bund yields, the ECB is probably happy with that and is frankly trying to make them more negative, as ridiculous as that sounds.
Okay, so we're going to take a little break. We also have a Facebook comment that John wants to share, and Mike is on the line. So we also have 2 lines open for you if you want to visit with Josh and Tom and Bob from SG Long. We'll be right back. All right, we're back on Talkback. It's Wednesday. It's the Montana World Affairs Council on the radio. Of course, Bob Seidenshort's with us, along with his compatriots at SG Long and Company. It's Josh Denny and Tom Kerr. And you, John, had a Facebook comment.
Yeah, a couple of them. First off, for Matt, a little tongue-lashing your way for the comments about the University of Montana and liberal arts educations. He says, remember when you speak of the UM, Peter, that there is a College of Technology attached to the UM with a welding technology program.
And it's called the Missoula College, by the way.
So there's that.
Yeah. Katie, and by the way, my son graduated from there with a degree, and he's employed right now, has a great life. So there you go.
There you go. Katie says, what is the situation with Greece, and how do you see it impacting the American market, if at all?
What?
What
Greece.
is the situation with Greece?
Meaning the debt situation.
It's not great. Really, although there are now sort of renewed positive signs for the Eurozone as a whole, the truly alarming data points that originally came out of Europe are still there. Extremely high youth unemployment in Spain. The economy in Greece has not improved really at all through this time frame. The market kind of calmed down as it relates to their perception of it. But the underlying economic situation really hasn't gotten any better at all.
So, Josh, how do you take a country whose economy is the size of Indiana? I mean, I'm not too far off. It may even be the size of Rhode Island in terms of GDP, but this is a small economy, but has major implications in terms of the fallout to the European markets and then, of course, to our currency markets and such. So give a little insight to why this little nation has such an impact.
There's a lot of differing opinions there, I guess, and I'll sort of abstain from offering my own. You could see, so if Greece was to leave the euro, which many feel is inevitable, a matter of when, not if, and it could be a number of years. Most people would probably say that the euro weakens on that event. It just loosens the coalition. There's less people participating in the currency, etc. One could also make the argument that the euro strengthens, minus Greece, that the remaining members of that group are stronger without their weakest link.
Meanwhile, what if they do leave? What happens to Greece then? Are they just going to on their own, or are they going to fold like a cheap suit, or what?
Yeah, in all likelihood, their currency explodes. A dramatic currency-driven economic readjustment process. They would probably within a matter of a year or two or three resemble a developing country.
Wow.
And kind of have to rebuild from that bottom.
Go ahead, Tom.
And even though the size or the absolute size of their bonds, their debt is not huge, as Bob mentioned, that still can have secondary effect, tangential effects on banks, institutions, investment firms, which could be quite negative and spiral out of control.
So, Tom, let's talk a little bit about the structural issues. You mentioned Spain still has very high unemployment, particularly amongst the youth. One of the things that I continually read is that Europe's problems are not so much driven by what you can do with quantitative easing, but unless they make structural changes, and what would those structural changes be, they will never get themselves economically healthy.
Sure, and it depends on country by country basis, of course. Some are doing a lot better than others, but a lot of it in terms of economic growth is how your government is run, how your employment is being managed, how your businesses are being driven, the regulatory environment. So the structural changes include all of that. Government restructuring, business restructuring, career opportunities. So it's a whole gamut of stuff that needs to create economic growth. And that's almost more of a political issue than an economic or investment issue.
And I would add to that although we've been talking about Europe here for the last couple of minutes, that many would make the same argument about us here, that you can only do so much monetarily, and then the other part has to come from the fiscal side or the DC side.
Okay, we're going to take a little break. And Mike, I promise when we come back from this break, you are first up. And we also have two lines open here on Talkback, 721-1290. Hey, we're back on Talkback, and believe it or not, we are rapidly running out of time here, so let's get some calls on. And Mike, first of all, thank you for your patience in holding, sir. You're on with Josh, Tom, and Bob. Go ahead.
Oh, you bet. Thanks for taking my call. I love conversations like this. This is information that actually affects people's lives as opposed to, what Kim Kardashian is doing or, stuff like that. My main question was, there was calls for China to decouple, I guess, from the U.S. dollar and have the yuan stand on its own. Can you explain that a little bit, and how that would affect U.S. interest rates and all the products that we buy that are made in China? And I'll take your call off the air. I'm heading over the road. So thank you.
Sure. So I guess to start at the beginning, the yuan is now what they call pegged to the U.S. dollar, in the sense that the Chinese central bank, which has essentially infinite spending power, arranges in currency markets for the yuan to not meaningfully trade away from a certain level as it relates to the U.S. dollar. This is convenient for a bunch of different reasons. We buy a lot of Chinese stuff. Increasingly, they buy a lot of our stuff. And when you sort of cut out the currency trade dynamic of that international trade dynamic, it eliminates one of the potential complexities. But at the end of the day, it's artificial. Currency pegs can only be held as long as the capital behind them is able to support them. And like I said, in the case of China, there's massive amounts of capital, so they can do it for a very long period of time if they want. But naturally, currencies should adjust to market forces, and most currencies do. A currency the size of the yuan to be pegged is highly atypical. What you'll see, and there was one a few days ago even, the Chinese central bank will stop trying to institute that peg. They'll sort of like pull it, and the yuan will appreciate dramatically over a very short period of time, and by that I mean minutes, and then they reinstate the peg. So they allow it to float a little bit at their will, but not for very long periods of time. If they were to truly decouple from the U.S. dollar, most people feel that the yuan would strengthen dramatically and relatively quickly. And what that would mean is that any good produced in China would become much more expensive in U.S. dollar terms. And what that would also mean, the converse of that would be true as well, is that U.S. produced goods would become dramatically cheaper in China. And there's all sorts of secondary effects too, but that would be the sort of primary effect.
I don't understand the mechanics behind it. You say pull the peg, I kind of get a little metaphor going in my head, but what are they doing to tie the currency to the U.S. currency? Are they putting money into the system or taking it out, or what?
So they'd structurally what you'd do if you're trying to stop a currency, in this case the yuan, from appreciating relative to another one, is you sell the yuan into U.S. dollars. So with that action, you're selling pressure on your currency, yours being the yuan, should lower its price. Buying pressure into the U.S. dollar should strengthen its price. And that's sort of the functional and the thing is you got to have enough yuans to like keep selling them constantly. Otherwise that peg breaks. And they do. So they can hold it.
So Josh, when you're looking at currency, the U.S. dollar right now is very strong relative to many other currencies, particularly against the euro. Can you and Tom talk a little bit about the implications? Because that's one of the reasons we've seen continued weakness in oil prices is the strong dollar. So explain why that matters and what's the impact in terms of the U.S. having a strong dollar, and is that a good thing?
Yeah, I'll let Tom discuss the equity part of it, but on the sort of economic part of it, there's positive and negative effects. I mean, a stronger dollar, as I just sort of explained, means that U.S. goods are incrementally more expensive internationally in non-U.S. dollar environments. It means that over time we should have more purchasing power here. Foreign produced goods should be cheaper here. So it does sort of have, if nothing else, sort of it rearranges the landscape a little bit for multinational companies.
Right.
In terms of affects the company profits that you're seeing is that these are real dollars. Currency translation isn't just a philosophical or theoretical thing. It's real dollars when it gets translated back to American dollars. So an international company that has large businesses or export businesses or business overseas, they will see their profits go down. A lot of these large companies, they grow 6, 7, 8%, but the currency effects, the negative effects of the strong dollar, bring those sales growth rates down to about zero. So it's a real dollar effect on these companies.
Okay, let's get back to the phone and say good morning to Roy. Roy, you're on Talk Back with Josh and Tom and Bob. Go ahead.
Good morning, gentlemen. I'd like to make a short comment in North Dakota. I worked in North Dakota for a year, and it was the best paying job I ever had in my life. Also, North and South Dakota are at the top of the list as far as the freest states in the Union. In other words, they have the least amount of government intervention. The people have the least amount of government intervention in their lives than any of the other states. And I think that's one of the main reasons they are prospering over there. I would encourage our listeners to call our legislature and our governor, encourage them to go over to North Dakota and see what they're doing over there and start doing it here in Montana.
Can I ask a question, Roy?
Yes.
In what specific ways are North and South Dakota more, quote, end quote, free than Montana?
Well, the George Mason University does a study every year. They have less crazy environmental regulations than the state of Montana does. Now, I believe in environmentalism, the point of being sane about it, but we're way overboard here on our environmental regulations. The other thing is they have less taxes. They have less regulations on the individual, what he can do in his life, and that less interference all the way around. The other question I have for your guest is, I have done quite a bit of study on investing, and I decided that mutual funds are the safest way to invest in, and I found out in more than one of the books I've read, they all seem to conclude that investing in the S&P 500 fund outperforms 70% or 75% of all mutual funds, and there's thousands of them out there. So I figured, why try to pick a mutual fund? And I picked some of them. Some of them are losers, some of them are winners. Not much of a winner. Why not just go with the S&P 500 fund? And I've been doing that, and I'll tell you what, it's been very good to me. It's been a consistent winner. It's been very good, and I'd like your guest to comment on mutual funds and specifically the S&P 500.
Okay, we'll do that, but we have to take a 1-minute timeout. So we'll keep you in suspense here for 60 seconds. Be right back. All right, we're back on Talkback 721-1290. Believe it or not, we're running out of time, and so let's get these question answered first.
Oh, yeah, sorry.
S&P 500.
Sure. The question as it relates to more of active versus passive management. So just to refresh that, passive management is where you buy an index fund, as the caller referred to, an S&P 500 index fund, where it's lower cost, but it buys every single stock in the S&P 500, whether it's overvalued or not. Where an actively managed fund, does the research, bottom-up fundamental research, try to pick good quality companies that are undervalued. And these cycle in and out. In a bull market like we've seen for the past 5 or 6 years, yes, a S&P 500 index fund will generally outperform active management. But where they kind of fail is in down markets or bear markets, because when you buy one of these index funds, you're guaranteed to go down what the market goes down, whether it's 38% in 2008, but you're guaranteed to go down 38% plus cost as well. And what active managers do, and we at SG Long are active managers for the most part, and we try to protect capital in down markets, and that's where active management comes in. So, the answer is you want to have a little bit of both in your portfolio to some degree, but active management and passive are both good components of a long-term investment strategy. Okay. John, you had a Facebook comment, right?
Well, I was just going to bring up the study. It's out of the Mercator Institute at George Mason University, the Mercatus Institute. And the top 5 states for freedom in the United States are New Hampshire, Tennessee, Oklahoma, North Dakota, and South Dakota.
Okay.
Montana ranks number 12. And what the caller said, according to their study, one of the ways that Montana took it in the shorts really was regulatory freedom, where we ranked 35. We were number 7 in fiscal freedom and number 23 in personal freedom. By contrast, North Dakota, number 1 overall, was number 4 in fiscal freedom, number 20 in personal freedom, and only number 4 in regulatory freedom. So I think what the caller was talking about, the various laws, regulations that we might have for extraction or other industries, might be the calculation there.
And that is a good point, and there's business aspects to be looked at for that. But the regulatory environment, obviously, we need sensible regulations, whether it's worker safety or environmentalism. But an overly burdened regulatory environment does affect employment, job growth. And you look at states, I'd be encouraged to see surprised to see where California is on that list, because they are losing jobs, businesses.
Out of 50 states, only number 49.
So who's number 50, John? Is it my state, New York, is the most burdensome?
New York, number 50. Welcome to Montana,
boys. And don't try to tell me that we're not number 1. Now, look, North Dakota, you can drill a well in North Dakota in terms of permitting at half the amount of days as it takes in Montana to get a permit for well drilling. So it's there are some business regulatory issues that sometimes are discouraging too, right, especially resource development.
I will say that according to the Mercator Institute map, the darker blue the state gets, the less freedom it has. Just thought I'd point that out. I don't know if there's any political implications at all. But.
But gentlemen, we have about 3.5 minutes left in the show. So Bob, any final words of wisdom from our folks at SG Long as to what we can expect? Or perhaps you might want to say, in a general base, if I have some money I want to invest, what do I do?
All right, so I'm going to give you guys 2 scenarios. Let's assume that for the next several years, we're in a deflationary environment. Please explain what that means, and if so, then what are the type of assets that would perform well in a deflationary environment? And then flip that and ask, in an environment where inflation is a part of the equation, what type of asset classes would perform relative to a deflationary environment?
Okay. I'll handle deflation. The short answer to that is that it's really difficult for all asset classes because it's difficult for the broader economy as a whole. And by difficult, I mean very, very, very difficult. Certainly when one owns stocks, bonds might do, or should, do certainly relatively well relative to stocks. Becomes a very difficult environment for commodities. I would say that lots of cash in that sort of environment, deflationary.
And on the equity side, it's a little bit of a mixed bag in terms of inflation. That's usually going to come with higher interest rates, which, as we spoke about earlier, could be negative. But there are certain sectors or industries that could benefit from that, and that would obviously be commodity-type sectors like the agriculture sector or the energy sector. So I think those could be positive in an inflationary environment.
All right, so in an environment where we have low interest rates, they're going to stay that way for a period of time, where should clients be positioning themselves in terms of their bond portfolios?
Just keep those maturities as short as you possibly can. That's a good, I think, defensive approach to take, and just stay focused on that.
I was going to say, John, you wanted to jump in there? So we have 2 minutes left in the show here, and so I'm kind of treading water.
All right. Well, if you're spinning, I'll ask a question.
I have the faintest idea what they're talking about.
One of the most devoted. People follow stocks and things like that, right? But one of the things that people are most devoted to, and I get calls as a guy that just runs the board in here from time to time about the issue of gold and whether or not it's a good investment. And people sell gold, and gold often sells on fear, it seems to me. I want to get your take on gold.
Well, it has a lot of negative connotations. It's not a business. It doesn't pay a dividend. It doesn't generate cash flow, but it does have defensive characteristics. And sort of the conclusion a lot of people have come to lately, it's more of a bet that all these moves we talked about by central banks and the Federal Reserve will not or have not worked. And that's sort of the conclusion, that it's basically a defensive posture in terms of risk. There's not a lot of risk in the market today as perceived by people, so gold is trading lower than it has been.
Why gold? I mean, there's lots of other metals out there, other valuable commodities. Is gold any more better than others? Should there be other linchpins other than gold?
Molybdenum.
The short answer to that question is no. Really, frankly, the reason gold holds its place in financial markets, or holds a place that it does in financial markets, is because it has done so for so long, and that longevity is really the only thing that makes it unique relative to other precious metals.
And gentlemen, we are flat out of time. I just want to say thank you to the folks at SG Long, Josh Denny, Tom Kerr, Bob Seidenschwartz, and John, what's coming up tomorrow?
It should be an interesting debate. We have Dr. Randy Julizia. He's famous for debating. He believes in creation opposed to evolution.
All right.
And he's a specialist on the human body.
Have a great day, everybody. We'll see you tomorrow.